Welcome to Trader TV, your insight into institutional trading. I'm Dan Barnes. Joining me today is Winifred Cisar, Global Head of Strategy at CreditSights. We're going to be discussing the level of bond issuance seen year to date and the impact that's having on secondary trading. Winnie, welcome to the show.
Thank you so much for having me, Dan. I'm delighted to be here.
How have issuance levels been this year relative to historical levels?
We're seeing two different trends in the investment grade and high yield markets this year. The investment grade market started off on a pretty solid pace, similar to levels that we had seen in January, February of last year. And then in April, things slowed down quite significantly, and April was a much lighter month than many people had expected as broader market volatility picked up. High yield is quite different. High yield has been a very slow issuance market this entire year. In fact, high yield is trending at a pace that we haven't seen since 2011, which was quite a rocky period in markets more broadly, and a significant drop off from last year's level, mostly driven from an anticipation of tighter monetary policy from the ECB and other central banks.
What are the other possible causes behind the levels that we might have seen?
As I just mentioned, central banks are driving a lot of this volatility in the market. We've seen volatility in equities, in rates, in commodities. Issuers, when they see elevated volatility and upward pressure on borrowing costs, they'll tend to sit on the sidelines and wait out the market to see if markets calm down a bit and it becomes more attractive for them to actually come to the market and raise new capital. Compared to last year, we now have borrowing costs at levels in line with a longer average coupon level. So they're still not elevated relative to historic norms, but they are significantly higher than last year. And that's keeping issuers on the sidelines.
To what extent does this represent a trend?
So in investment grade, we've only really had 1 month of very light issuance. The bigger trend is that volatility and upward pressure on borrowing costs. Borrowing costs are definitely sticking at these higher levels. So I do think that that indicates that there is some sort of trend in terms of the assumptions that companies are going to make about how much it's going to cost them to either raise new debt or refinance existing debt. In high yield, the trend is clearly taking effect, given that it's now been 5 months of very light new issuance.
Then how do we see this impacting secondary markets?
So secondary markets are frequently driven by what's going on in the new issue market. A lot of times investors will be looking at their portfolios, and if there's a new deal that they want to buy, they'll have to rotate out of an existing position. This naturally drives incremental trading in the secondary market, not only in the new bonds that are being issued, but also in existing holdings. When you have a significant drop off in the primary market, then ultimately what you see is investors just kind of keeping steady, keeping their portfolios close to home, and not necessarily doing a lot in the secondary market.
What dynamics might affect levels going forward?
So going forward, we do have to come back to central banks. The rate of policy tightening and what that means for overall borrowing costs is definitely going to drive new issue activity going forward. The broader macroeconomic fundamentals, whether central banks can actually navigate a global soft economic landing, keeping ratings intact, minimizing downgrades and defaults, that's going to be a big driver of ability to access the capital markets and also willingness to access the capital markets. And then finally, we always like to say that supply follows demand, and demand for fixed income this year has not been good. In fact, we're seeing major outflows pretty much from every fixed income asset class under the sun, including corporate credit. And until we see some sort of pause in that trend and investors feel more confident that they don't have to really preserve cash balances to manage those outflows, then we're probably not going to see supply pick up.
Winnie, that's been fantastic. Thank you so much.
Thank you, Dan. It was a pleasure.
I'd like to thank Winnie for her insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net.